For more than a decade, Bitcoin lived inside a powerful illusion. It was the outsider asset, the instrument of financial escape, the technology that promised to separate money from the state. People believed that as long as Bitcoin existed, there would always be a refuge beyond government reach. But here is the reality that almost no one processed. The United States government is now one of the largest Bitcoin whales on Earth. And once you understand that, the narrative surrounding decentralization begins to fracture. Everything changed on March 6, 2025. On that day, the US government established the Strategic Bitcoin Reserve, placing Bitcoin in the same conceptual category as gold and petroleum. This was not acknowledgement. This was an elevation. This was the moment Bitcoin crossed an invisible line and became a strategic national asset. And in the language of statecraft, once something becomes strategic, it stops being neutral. It becomes a tool of planning and a component of national survival. So let me ask you directly, what does it mean when the most powerful government in the world stockpiles the asset that was designed to weaken its control? What happens when a government with unmatched legal, financial, and military power decides that Bitcoin is no longer an external threat, but an internal resource? And more importantly, is this the first quiet step toward a digital version of the 1933 gold confiscation? In this investigation, we will break open the executive order. We will explore the historical echoes behind it. We will decode why the government wants Bitcoin, how it intends to use it, and what this means for anyone holding BTC today. More importantly, we will examine what happens when state power and decentralized technology collide, not in theory, but in practice. This is not a simple policy update. This is a shift in monetary architecture, and the most important truths are the ones hiding quietly between the lines. To understand the Strategic Bitcoin Reserve, we must first understand the pressure building beneath the surface of the US financial system in 2025. Because no government reclassifies an asset as strategic unless something foundational is under strain. By early 2025, federal debt had reached levels that were not only historically large, but dangerously expensive. Interest payments were growing faster than any other category in the federal budget. They were projected to surpass Medicare, Social Security, and even the US defense budget. When a nation spends more servicing yesterday's obligations than securing tomorrow's stability, it enters a zone of structural risk. On the global stage, fragmentation accelerated. Nations exposed to dollar sanctions sought parallel systems. Emerging powers built alternative settlement networks. The dollar remained the world's reserve currency, but its dominance was no longer unquestioned. Confidence, once unquestionable, had softened. And in geopolitics, perception is power. These forces placed the United States in an unfamiliar position. It needed additional forms of stability, assets uncoupled from traditional monetary levers, assets that could not be printed, assets that were not dependent on treasury yields or the health of the bond market. Enter Bitcoin. For the first time, Bitcoin possessed the characteristics of a modern strategic resource: fixed supply, global liquidity, independence from traditional macro cycles, decentralized settlement, resistance to political manipulation. In that environment, Bitcoin became what financial historians call a counter-cyclical anchor, an asset that strengthens when pressure builds inside the conventional system. The Strategic Bitcoin Reserve was not an endorsement of cryptocurrency culture. It was a recognition that the existing financial architecture was entering a period of stress. The government did not embrace Bitcoin out of enthusiasm. It embraced Bitcoin because the conditions of 2025 left it with fewer tools than before. This context is critical, because once an asset is pulled into the center of national strategy, the question stops being whether the government will influence it and becomes how far that influence will reach. Now, we enter the core of the story, what the executive order actually does. And once you understand its mechanics, the future becomes easier to foresee. The most important element is deceptively simple. Bitcoin is officially designated a strategic national asset. This is not symbolic. It places Bitcoin in the same legal and conceptual category as sovereign gold reserves, petroleum stockpiles, and critical minerals. These are assets governments do not sell casually. These are assets governments integrate into long-term planning. The next component is consolidation. The United States already controlled over 200,000 Bitcoin seized through lawful forfeitures in cybercrime, drug trafficking, and money laundering cases. Before 2025, these assets were auctioned off, usually at discounts, in a way that weakened the government's position and created market distortions. The new order prohibits liquidation. Those 200,000 Bitcoin can no longer be sold. They can only be held, accumulated, and managed as part of the National Reserve. This alone signals a profound change. The government has shifted from seller to holder and potentially to future accumulator. To support this shift, the order mandates the creation of interagency working groups, bringing together Treasury, Commerce, Justice, and others. Their job is to build Fort Knox level custody for digital assets, physical protection, cryptographic redundancy, multi-signature controls, continuous auditing, and threat monitoring. When a government builds infrastructure at this scale, it does so for one reason: long-term accumulation. Then comes the most subtle and most powerful feature. The order directs agencies to develop internal valuation models. In other words, the government can define an official Bitcoin price independent from the open market. This is not an academic tool. It is a mechanism of power. In 1933, the Treasury revalued gold from $20.67 per ounce to $35, increasing the value of its reserves by nearly 70% overnight. That valuation was not driven by markets. It was driven by state necessity. The 2025 order creates the digital equivalent of that mechanism. Finally, Bitcoin is woven into broader financial security planning. Agencies are instructed to design acquisition frameworks consistent with national strategy. This is a quiet language. But quiet language is exactly where expansion begins. Taken together, the order creates a new architecture. An architecture in which Bitcoin is no longer outside the system, no longer adversarial, no longer purely decentralized. It becomes a tool the state can shape, influence, and eventually direct. Now that the architecture is clear, we can turn to the part of the story where history begins to repeat itself. To grasp the implications of the 2025 order, we must revisit the last moment when the United States confronted a crisis so deep that monetary rules themselves were rewritten. That moment was 1933, a nation crushed by a deflationary spiral, banks collapsing, unemployment is soaring, gold draining out of the financial system, confidence evaporating. In that environment, President Franklin D. Roosevelt issued Executive Order 6102. The order required U.S. citizens to surrender their gold, not because gold was illegal, not because citizens had done anything wrong, but because gold represented control. As long as gold sat in private hands, the government could not reset the monetary system. The surrender occurred at a price of $20.67 per ounce. Once centralized, the Treasury revalued gold to $35 per ounce. Overnight, the government reduced the real burden of its national debt by almost 40%. This was not taxation. This was not austerity. This was a revaluation, a monetary reset disguised as policy. Now look at 2025. In 1933, the government declared gold strategic. In 2025, Bitcoin receives the same designation. In 1933, gold was consolidated. In 2025, seized Bitcoin is consolidated and protected. In 1933, valuation diverged from market price. In 2025, agencies are instructed to build internal reference prices. But here is the difference that matters. In 1933, the government could compel citizens to surrender gold. In 2025, it cannot compel surrender of Bitcoin, not because it wouldn't want to, but because the technological landscape has changed. Bitcoin can be self-custodied, it can be hidden, it can be held offline. Confiscation at scale would be politically and technically impossible. So instead of forcing surrender, the government is building the infrastructure of control, the same way it built the structure for the gold revaluation before the order was executed. History tells us governments rarely start with loud action. They start with the quiet one. They build custody. They build valuation tools. They normalize centralization. And then, in the moment of crisis, the real action appears. Bitcoin now sits in that first stage, And understanding that stage is what allows us to see what might happen next. Once Bitcoin became a strategic national asset, the government acquired three layers of influence, each one subtle, each one powerful. The first is market power. A government holding hundreds of thousands of Bitcoin becomes a structural force in a finite ecosystem. Scarcity amplifies influence, and the ability to establish an official reference price extends that influence beyond markets and into institutions. A government-defined valuation affects taxation, accounting, collateralization, and risk modeling. It influences how banks treat Bitcoin, how corporations hold it, and how international actors interpret its legitimacy. The second layer is infrastructure power. Custody infrastructure is not neutral. It signals intent. When the government builds high-security storage designed for expansion, it is preparing for a future where it holds far more Bitcoin than it does today. This aligns with legislative proposals, including the suggestion that the Treasury might eventually acquire up to 5% of all circulating Bitcoin. Infrastructure reveals ambition. You do not build a vault for the present. You build a vault for the future. The third layer is regulatory power. Bitcoin's code is decentralized, but its interaction with the world is not. Every exchange, every custodial wallet, every bank on-ramp, every tax filing, every AML checkpoint, these are all points of pressure. Through regulation, the government can make privately held Bitcoin more cumbersome to move, while making government-held Bitcoin more legitimate and liquid. This is not about outlawing Bitcoin. This is about tilting the entire playing field. When combined, these layers transform Bitcoin from an anti-state instrument into a component of statecraft. One the government can shape, one it can influence, one it can potentially direct. And once you see these layers clearly, the next step becomes much easier to imagine. The 2025 executive order does not explicitly threaten private Bitcoin holders, but the architecture it creates reveals four scenarios that become plausible under pressure. The first is mandatory acquisition. In a fiscal crisis, the Treasury could require certain holders, large institutions, corporations, or citizens above a wealth threshold to sell Bitcoin to the government at a specified price. This would be framed as stabilization, not seizure. It would be legal, orderly, and temporary, but the effect would be unmistakable: a forced transfer of supply. The second is official price revaluation. If financial pressure intensifies, the government could set an official Bitcoin price far above market value to strengthen the balance sheet. The precedent is 1933, where gold was revalued upward by nearly 70%. But the consequences would ripple everywhere. A higher official Bitcoin price would, by definition, weaken the dollar. Inflation would rise, living costs would shift. This would be a silent reset, not declared, but engineered. The third scenario is decentralization through regulation. Bitcoin itself cannot be controlled, but the places where people interact with Bitcoin can. Wallets can be labeled, addresses can be blacklisted, institutions can be required to hold only clean Bitcoin. Over time, privately held BTC becomes harder to use, while government-held Bitcoin becomes the standard inside regulated markets. The fourth scenario is global realignment. If the United States moves aggressively into Bitcoin accumulation or valuation, rival nations will be forced to respond. Some will accumulate Bitcoin strategically, others will ban it entirely. The global crypto landscape could fracture into separate regulatory blocks, one aligned with state influence, one resisting it. These are not fantasies. These are logical outcomes when you combine scarcity, state necessity, and the machinery of policy. And each scenario leaves private holders with a critical question. How prepared are you for a world where Bitcoin is no longer outside the system, but inside it? Knowledge is only useful if it becomes preparation, and preparation must begin before pressure arrives. The first step is vigilant monitoring. Regulations rarely emerge suddenly. They evolve through tax proposals, reporting thresholds, and AML expansions. Each new rule subtly alters incentives. The more friction introduced, the more the landscape shifts. The second step is diversification. Bitcoin can be a hedge, but no hedge is absolute. gold, real estate, cash reserves, foreign assets. These create layers of insulation. Governments can apply pressure to one asset. They cannot apply equal pressure to all. The third step is self-custody with realism. Holding your own keys protects against exchange failures and custodial seizures, but it does not protect against reporting requirements or policy shifts that target liquidity. Self-custody is essential, but it is not invulnerability. The fourth step is jurisdictional optionality. High net worth individuals have used multi-jurisdiction structures for decades to reduce political risk. Bitcoin is no different. A corporate presence in a friendly jurisdiction, a trust, a legal anchor outside a single national system. This is not evasion, it is optionality, the most important asset in periods of transition. And finally, there is mental preparedness. The ones most harmed in 1933 were not those without resources. They were those who refused to imagine that the rules could change. They believed stability was permanent, until it wasn't. Preparation is not fear, it is discipline. When we step back from the specifics, a clear pattern emerges. Every era eventually reaches a point where traditional tools lose their effectiveness. When that happens, governments search for something scarce, something credible, something external to the system that can anchor confidence. In the 20th century, that anchor was gold. In the 21st century, that anchor may be Bitcoin. The strategic Bitcoin reserve does not guarantee confiscation. It does not guarantee revaluation. It does not guarantee mandatory acquisition. But history has always taught one simple truth. When an asset becomes strategically important, the state does not let it remain outside its grasp. Influence replaces neutrality. Infrastructure replaces ideology. And control becomes a matter of timing, not intention. Bitcoin may have been created to escape government power, but the conditions of 2025 have brought it directly into the center of American statecraft. Investors who understand this will navigate the coming decade with clarity. Those who ignore it may be blindsided when the next structural shift arrives. And now, as before, the foundations of that shift are already forming beneath our feet. If this opened your mind, stay curious. The next story is already unfolding beneath your feet.